also hoping to help matters in the course of the conversation in the markets this week. Bank earnings kick off this week, where we'll get a better picture on the impact of the banking turmoils from March. JP Morgan among the big names posting their quarterly results tomorrow. Chief Executive Jamie Dimon already warning in a letter to shareholders earlier this month on the banking crisis and the, quote, repercussions from it for years to come, end quote. So how will banks hold up compared to Wall Street expectations? Here to discuss this and more, we've got Pucknews founding partner Bill Cohan, along with Gillian Tett, chair of the U.S. Editorial Board and Editor-at-Large of the Financial Times. Great to have you both here with us this morning. William, I want to begin with you this morning, actually. Bank profits, what are you expecting from some of the Wall Street banks as they report? And ultimately, is this going to be a rosy scenario that they're trying to paint a picture of? Or is there something else that's in the play or at work?
Well, Brad, obviously it was a tough quarter in the banking sector generally, but I think for the big Wall Street banks, because of this so-called flight to quality that occurred as some of the regional banks either were liquidated or stumbled and had to be rescued by the FDIC, I think that the big banks are probably going to be fine. Jamie Dimon once told me that basically 80% of their revenue and profits in any given quarter are pretty much locked in. And so the 20% is variable. Obviously, investment banking has had a tough quarter. There hasn't been a lot of investment banking underwriting, IPOs, M&A deals. So the bread and butter in investment banking had a tough quarter. Trading probably had a good quarter given all the volatility. And the rest of the bank, I'm sure, is doing just fine. So it may not be as robust at the JP Morgan Chases of the world as it had been in, say, 2021, but I think it's going to be better than people think.
And when we talk about what to expect from the banks, we could expect more provisioning, guys. Yesterday, we spoke with the IBM Vice Chairman Gary Cohn, who, of course, was at Goldman Sachs, on the sentiment of banks in the current economic environment. And this is what he had to say.
So banks are always concerned about additional regulatory costs, additional regulatory hurdles. And what does that mean? So holding more liquidity and holding more capital is always a good prophylactic against another regulatory move. Mm-hmm. So I would characterize banks right now in a relatively conservative mode.
Gillian, how is that going to translate to the provisioning from the banks and the commentary? Are we going to get sort of a flood of reassuring or attempts at reassuring from the banks as we start to hear from them tomorrow?
Well, I think one of the key questions people are going to be looking for is signs that the shock we had in March might be moving from an interest rate shock, which was quite different from what we saw in 2008. I mean, it really was a case of losses being caused by misjudging interest rate risk rather than credit risk. But the question we're looking at now is, are we moving into a credit risk problem as well, where essentially you're seeing corporate loans and consumer loans going into default, and whether the banks will be provisioning against that or not. Now, that obviously depends on the economy, but the chances are that we will see provisions for that rising quite notably, and they should rise quite notably because there is a chance that particularly in sectors like commercial real estate, there's a lot of pain to come. The other question, of course, people will be looking at is what kind of data do we get on deposit flight or deposit inflows? Because although we've had macro level data about how consumers have been moving from banks to money market funds and from small banks to larger banks, what we've not had is individual bank by bank breakdowns. So in many ways, the key question that investors will be looking for is evidence of what's actually been happening in terms of depositors moving their money in response to March's turmoil.
Gillian, just to follow on that, how long could credit risk particularly show up in a systemic type of stickiness, if you will, and really kind of from this perspective that is going to be one of the larger questions that we have to hear what banks are saying around that credit risk as well?
Well, how long is a piece of string? I mean, the honest answer is we just simply don't know. And it obviously depends a lot on what happens on the consumer side to inflation, to employment in particular. That's historically been one of the key drivers of consumer defaults, and the broader outlook for the economy. As far as the corporate sector is concerned, there are two really interesting questions here. One is that companies, for the most part, went into this whole period pretty cash rich. I mean, it's been a pretty good few years for companies in terms of their profit margins. That's the overall picture. But of course, you've got this very large tail of risky, troubled companies, the leveraged loan world, which are basically already displaying a lot of signs of real distress. Now, what's really interesting about the current cycle is that for the first time in history, you've had private capital play a really important role in the extraordinary bubble we saw between 2009 and 2022. And we simply don't know exactly how private capital is going to respond to a tightening of credit conditions and tightening of interest rate cycle. You know, in the past, we've had bubbles go pop, like in 2008. This time round, we may see more of a long, slow hiss as credit is impaired, but the signs of that aren't immediately obvious. Now, insofar as banks are exposed to that, because they're either funding the private capital vehicles or they're funding bridge loans for some of the private capital deals, that again could force a lot more provisioning going forward. But that's going to be slower and in many ways much harder to track, precisely because private capital is private and therefore more opaque.
And so as you're talking, Bill, to some of the executives at some of the banks here, kind of how are they viewing where we are in this crisis? And if indeed, as Gillian is talking about, are we moving into a credit risk phase, or are they sort of brushing off some of the concerns that are out there?
Well, you know, Gillian, of course, makes some very good points. I think that there's a couple of offsetting factors if you look again at the big Wall Street banks. One is, you know, they are in the moving business, not the storage business, Julie, and you know this. And so one of the bottlenecks has been that a number of leveraged deals that the banks committed to before April 2022, when the Fed started raising interest rates, were in a totally different interest rate environment. And they still have a number of those loans, including Twitter and, Tenneco and some others on their books, totally billions of dollars, that they're really having trouble moving off. They had to recently, last week, moved off the Citrix deal that had been hanging on there for a while and took a big hit, about $1.5 billion loss across the banking sector. If Twitter has to move, that could be a $6 billion loss, because those bonds, that debt is probably trading at around 50 cents on the dollar if you really were honest about it. So that is one big problem. The offset to that, of course, is that, at the big banks where there's a flight to quality, they're paying basically still close to zero for their deposits. 1 basis point on checking, 2 basis points on a savings account at JP Morgan Chase. And they've got, $2.5 trillion of deposits, and they're able to put that in treasuries that are yielding a lot more than that, or in the deposits of other banks that are yielding a lot more than that. So they're making money just by pretty much doing nothing at the big safe banks. But they do have this overhang, not actually at JP Morgan Chase, interestingly enough, but at other banks, B of A and Barclays and Goldman Sachs have this overhang of loans that they made, leveraged loans that they made in a different interest rate environment that they have to move off. So there's a lot of competing dynamics here, and that's what's going to make this earnings report this week so interesting.
Gillian, is there anything that the Fed could be listening into within the commentary of some of the bank execs, given the turmoil that had ensued mid-March, where it could change at least the discussion or the tenor of their discussions ahead of their next meeting? I think you may. Oh, there we go. We're starting to hear you now.
I think the Fed, like everyone else, is going to be looking very closely at the deposit data, although one hopes they have better information than most investors on that front. They'll be looking very carefully at the credit risk profiles that the banks are assuming. I mean, that's absolutely critical. And as Bill just said, very, very correctly and very smartly, and he knows this better than almost anybody else, the question of what's going to happen to all those hung bridges, all the financing the banks have provided for deals like Twitter will be absolutely crucial. And coming back to this issue about, the private capital questions, about all the financing deals financing they provided for deals. I mean, we're assuming there's going to be a slow burn, as a hiss, if you like, in the private capital sector as things get marked down. It's not also inconceivable that you might actually see, one big deal go pop or go badly wrong, and that would force the investors in private capital vehicles to demand a faster write-down, to demand more clarity. I think, again, the Fed will be very, very alert to that, and particularly alert to what's happening in the commercial real estate sector, which, of course, is on many people's radar as a real area of potential concern.
And finally, on a little bit of a different note, guys, Bill, your recent piece where you talked about Jamie Dimon, the Jamie and Janet show, as he went once again down to D.C. to try and work on this latest rescue, it got me thinking a little bit about his tenure at J.P. Morgan, for that matter, Brian Moynihan at Bank of America. Some of these bank CEOs have been around for a long time. And it made me wonder a little bit about when we might see a changing of the guard. Yes, Jane Fraser's newer at Citi, for example. But I do wonder when we're going to see that next phase, because these people are so entrenched and so really iconic at many of the banks. What's your thinking on that, Bill? And then, Gillian, I'm going to ask for your thinking on it as well.
Well, Julie, Charles de Gaulle once said that the graveyards are filled with indispensable men. So I know Jamie seems indispensable. Brian seems indispensable. James Gorman seems indispensable. At least, in Morgan Stanley, there's a clear succession program underway. It might be a few years, much cloudier at both Bank of America and at JP Morgan Chase. A lot of talent has left JP Morgan Chase waiting for Jamie Dimon to perhaps be selected Treasury Secretary to succeed Janet Yellen or to retire. It's a bank loaded with talent, but who it's going to be and when is a big open question. Bank of America, same thing. So succession is the most important thing that a CEO can do, Julie. And, Jamie Dimon and Brian Moynihan need to get it right.
Gillian, do you think that this is something that investors are paying enough attention to?
I think they certainly are, but it's been going on for such a long time that these conversations feel a bit like Groundhog Day. And to be honest, the entire crisis of March in some ways felt like Groundhog Day, because so many of the characters that Bill and I spoke to in 2008 and wrote about, are still there in some form. It's good because you do have a depth of experience. It's bad because actually, as and when they do move on, it's going to potentially create a bit of a shock. So I strongly agree with Bill that there needs to be more discussion about succession. And the fact that Jamie has not groomed visible successors who he's managed to keep in the stable is in some ways a black mark against his name. Now, that could change. If we end up with a smooth succession in a few years' time, then suddenly historians really will deem him to have the crown of Wall Street in a way that he would very much like to have. But at the moment, it's a very open question about whether any succession will be smooth or not. And let us not forget just how critical JP Morgan is, because it's not just a question of Jamie going down to see Janet. It's a question of Jamie going down to see the three J's, Janet, Jay, and Jamie. And, he has a pivotal role in Wall Street, and people will be looking for him to show that he can build a path to the future, not just the past.
Yeah, good points all. Thank you both. Appreciate it. Don't think we're going to get anything on the succession front when we get earnings, but we'll keep an eye out for hints. The Financial Times' Gillian Tett, along with Bill Cohan, Pucknews founding partner. Thanks to you both. Appreciate it. Good to see you again.
Thank you.
Thank you, Julie.